With the markets being very volatile in the recent times, there's a lot of deals out there at the moment. Today we're going to talk about 3 stocks to buy in March 2022. We'll have a large cap, a medium cap and a small cap for you here today. All of them have one thing in common though. They've all been falling more than 60% in the last year. So let's get straight into it. Hi, if you're new here, I'm Robert. Welcome to my channel. On this channel, we're looking at the pros and cons of the stock. We are trying to get an unbiased opinions of all the stocks that we present here. If you like this content, please consider subscribing and liking the video. But let's get going. Well, the first stock we have to talk about, you guessed it, is Hims & Hers Health, ticker symbol HIMS. Been falling 75% over the past year. And kept falling, no end in sight. We don't really know where is the support level here anymore. We thought about it at 6, then we thought it's at 5. Now we're sitting at 440. The market capitalization for this one is a small cap is at $865 million at the moment as it stands. It's just been falling and falling and falling. It has basically been caught in this whole macro theater of, increasing interest rates and so on, as they are a high growth company, not profitable at the moment, only been operating for the past 4 years, only been public since last year. So definitely a higher spec play, but in terms of valuation, looking very attractive at these levels for a high growth company. So we're starting at a 25 price to sales ratio, and as the year went on and as the stock price kept falling but the revenue numbers went up, we had the price to sales ratios falling significantly, now sitting at a 2.69 at the moment, which I think for the revenue growth that we have with Hims & Hers is a significant discount to what it should be trading at. If we look at the actual financials of Hims, you will see that revenues have been increasing steadily and actually exponentially over the past 2 years, while gross profit also has been steadily climbing from 29% to now over 76%, which is just an impressive gross margin, meaning that if the company going forward can reduce their marketing expenditures and other expenses relating to the brand expansion, we will have a significant portion of that coming down to the bottom line, to the net income, generating positive cash flow going forward. So this is what we want to see. In terms of the balance sheet, we have no debt currently. The company has been funded purely by capital injections and capital raises, which is pretty good to see. And also, cash position has been piling up, loading up. They're sitting at a 250 million right now at the moment. They're about to release their earnings this week. I'm gonna make a special video just on that, and then basically after that I'm planning a deep dive on this one. But this is definitely one to look into, have a look for yourself. But let's move on to the next stock. The next one is a really good one. We have a medium cap here, Twilio Inc., ticker symbol TWLO. They've been falling over 61% over the past year, similar to him. So as we said, basically just been hammered with the macro environment that we are in the moment, whilst they've been reporting better and better earnings and numbers with very strong growth as such. Just for a matter of fact that they're not profitable yet, and they are considered a higher risk play as they are a high growth stock. We do have the same graph here, the price to sales ratio graph. We do have a longer time frame to look at, as they've been public since 2017. You can see that the price to sales ratio has been dropping significantly since February 2021. Since then, basically in free fall mode, looking now at a level that we haven't hit since the COVID pandemic. So that just shows how the market is fearful at the moment, what the market is valuing these types of stock at the moment. Basically, when we had COVID, right, the assumption was everything would be shut down over the next 1 or 2 or 3 years. Having companies like Twilio that not making any money at the moment, being in a very tough space if that was to happen. But now Looking at this, I mean, we have everything open up. We have the economy actually showing strong numbers with actually inflation going high, whilst the price to sales ratio has been hammered now to 7.35, which is very similar to the lowest of the lows for the COVID pandemic, for that flash crash that we had. I mean, yeah, we can say that a 32 or 31 price to sales ratio in February 21 was probably overvalued and was not a good time to get into the stock. But they have been performing very well, and they have been reporting very strong revenue growth numbers. I mean, you can see here 60 to 50 to 70% growth on revenue consistently over the last few years. Really strong revenue growth, similar to HIMS. They have also very strong margin here, over 50%. I think that's actually improved in the last quarter as well. So similar to HIMS here, as just on a larger scale, basically, they can obviously with their software, so they're the communications platform and other software platforms for companies which they embed into their own IT environment. So we can see that, you know, they can obviously scale more, and they'll handle dealing with larger numbers here than, and that's why the market cap of $28 billion. But this is very much a good one to look into as well. We do have some long-term debt here outstanding at almost $1 billion. But if you look at the cash and short-term investment position, we do have over $5 billion there sitting, which basically means that they could pay off their debt 5 times. And this is what you want to see. If there is any debt at the company side, that they have the strong cash flow or cash balances to actually, support that and pay it off if they had to. This is definitely a stock with a large total addressable market TAM in front of them. They already have the majority of the market, and their market as such is expected to grow over 20 to 25% a year. So this is definitely a stock with a great future ahead of them. And they have a consistent net dollar retention rate of around 130%, which means that whatever they have previously gained as customers, those customers pay 130% of their revenue that they initially signed up for, showing that the service is used even more as the service is acquired. Basically, they're even adding on other elements to it and spending more money. The next and last stock on our list is PayPal Holdings, ticker symbol PYPL. Yes, also been falling roughly 62% in the last year. Just been hammered. Used to be like one of the top holdings, one of the large caps, mega caps of the market, and always was a favorite for a lot of investors, and was always trading at a premium price, to be honest. So now seeing that one down so far, 62% in 1 year, is just crazy for me. Market cap sitting at 120 billion right now. So it's just being cut in half basically. And if we're looking at the charts here, so I've pulled up, they're actually obviously profitable business and very strong free cash flow generator. So I've pulled up the charts for the enterprise value to EBITDA and the price to PE, price to earnings ratio, because this is basically a more appropriate way to value or to look at a multiple to use for PayPal Holdings. Starting with the EV to EBITDA, we started around a 45 range, 44 here, just March 21, and then we have been dropping since then steadily, especially around September, October last year. We can say that 40 was a bit of an overpriced multiple, but if you zoom out a little bit, you will see that they've been trading like this for the past 2 years. Before that, they actually traded around a 25 to 30, 27 range of EV to EBITDA. So now seeing them at a below 16 EV to EBITDA is just crazy for me. That really shows you that even if you think that the last 2 years was a bit of a hype season, or was a bit of a premium allocated to the stock and its growth sitting around a 40, then you would definitely think that still it's much undervalued at the moment, as they were sitting previously at around a 25 to 27 range, a very steep discount here at the moment. And also when you look at the PE ratio, we get a similar picture. So they have been trading historically, I would say, around the 34 to 36 range. Then last 2 years, also in line with the EV to EBITDA, trading a bit of a higher premium here at around 50 to 60, but now dropped all the way to be around a 22 trailing PE. So that means it's as well as for the EV to EBITDA, the PE ratio is also very low compared to historical ways of how the market has been valuing the stock. So the question is that justified, right? Why is the market giving PayPal suddenly such a low multiple compared to previous years, compared to how the stock has been trading historically? So this is something you would actually have to do your research on and see if you agree or disagree, because obviously the market has spoken at the moment, giving them a really steep discount. So you have to decide, should they be trading more at historical norms as the 22 EV to EBITDA range, or is a 16 EV to EBITDA actually justified at the moment? That said, let's look at the financials of PayPal here. We do see revenue have been growing strong over the last 3 to 4 years, consistently above the double-digit range, so anything from 15 to 20%. So it's very strong growth, and as the company obviously matures and gets bigger, the percentage growth numbers get smaller. It's just a mathematical equation basically. As the numbers that we are dealing with are bigger, those growth percentages seem smaller, but we're still growing at a rapid pace here. Billions of dollars of revenue for each of the years, so it's very strong growth. Nevertheless, still going. That actually translates into a very good around the 46 to 47% gross margin, very strong gross margin. Since the company is already making free cash flow and net income, we do have a very nice operating margin of 17% going down to the bottom line. And we do see the same thing when we go over to the cash flow. We have cash from operations steadily being going up over the past years, from 2.5 billion to now 6.3 billion, and even more in the current quarter, reducing the capital expenditures. We do have very nice free cash flow that's been generated from this business. So this is already a stock that's profitable, that's making a lot of money right now, in contrast to the high growth tech stocks that are a bit more speculative, as we're expecting from them growth to come in the future, while the discounted cash flow model obviously is more heavily discounting those types of companies. Why are we discounting PayPal the way we are at the moment? That is just not something that makes much of sense for me. Looking at the balance sheet here, obviously very strong. We do have some long-term debt here at $8 billion. But if you look at the cash and the short-term investment position, we do have 9.5 billion sitting around, just basically paying off that long-term debt in one go if they wanted to. And other than that, being in a very strong financial position otherwise as well makes this a very good balance sheet. And looking at PayPal's competitors here down here, how those multiples actually stack up when you compare it to some of the other players in the fields like MasterCard and so on, we do see that revenue, EV to revenue, is very low at 4 at the moment compared to a 16 for MasterCard, for instance. Same thing goes for the EV to EBITDA, as we've seen before, 15 to 16 right now, comparing to a 27 for MasterCard, which is for me just insane, because MasterCard is just being around for a long time. They're not growing at the rate that PayPal is growing at. And that's why PayPal historically had that high, the high multiples, the higher premium allocated to it. Now looking at actually a steep discount from those, and when we look at the median, we do see from a median perspective and the mean, we are below those. And when we look at the mean value for comparable companies to PayPal, we do see that we are below that in terms of the price to sales ratio, 4 versus 6 for the industry. Same for EV to EBITDA, 16 versus 18 for the industry. For PE, we're still quite high up there, but you have to understand that PayPal was always trading at a premium historically, as we've seen before, given that strong record of growth, given that strong execution of management, consistent double-digit growth. That's why it was basically deserving that higher multiple, which we have come down from, still above the industry though. And in terms of free cash flow, we're half of what the industry is trading at, looking very strong here. As we saw that before in the cash flow statement, very strong free cash flow, which is important in this type of environment, and this is actually what the market should be focusing on. PayPal has just been falling in line with those high growth tech speculative plays. In addition to the macro factors, PayPal has been falling, or PayPal stock has been falling over the past 6 months or so, definitely showing lower than usual growth for PayPal, which is always at the higher end of the double-digit range for, basically more towards 20%. Now I've been seeing growth around the 10% range, which has been shocking the market, and that's why that reaction on top of the macro uncertainty environment, the stock has been hammered to those types of levels. But we do have to have in mind that the company is different to those high growth, high speculative companies. They already have the profit right now. You don't have to wait to get free cash flow back from the company. They're already producing a lot of that. So looking at a very strong company here at these levels. Let me know in the comment if you enjoyed this video. Let me know what else are you buying or what else are you looking at the moment. So maybe I can cover that in other videos going forward. But until then, see you next time.